Bob was looking to make some extra cash without breaking the bank. He'd read that with just a small, steady commitment of $25 a week, it was possible to build a portfolio that could eventually pay over $5,000 a month. The idea seemed too good to be true, but he decided to dig into the strategy behind it. He discovered something called the DRIP investment strategy. DRIP, or Dividend Reinvestment Plan, felt like planting a seed and watching it grow into a mighty tree. Instead of soil and water, you used your dividends to buy more shares, which then generated more dividends, creating a cycle of growth. Here's how Bob understood it. Imagine owning shares in a company that pays dividends. Instead of taking those dividends as cash, you reinvest them to buy more shares. Now you own more shares, which in turn produce even more dividends. It's like a snowball rolling downhill, getting bigger with every turn. One of the key benefits was compound interest. When you reinvest dividends to buy more shares, and those new shares pay dividends that you reinvest again, the snowball effect leads to exponential growth over time. Bob ran through a simple example. Suppose a stock is worth $20 per share and you own 100 shares. The company pays a $1 dividend per share each year. At the end of year one, you'd have $100 in dividends. Instead of cashing out, you reinvest and buy 5 more shares. Now you own 105 shares. The next year, instead of 100, you'd receive $105 in dividends. The following year, 110 shares, then 110, and so on. Over time, the investment grows larger and larger thanks to the power of compounding. Another advantage was dollar-cost averaging. Rather than trying to time the market, you buy shares regularly, regardless of whether prices are up or down. This smooths out the highs and lows, averaging the cost per share. If you invest a fixed amount each month, you'll automatically buy more shares when prices are low and fewer when they're high, reducing the impact of market fluctuations. Finally, the convenience of automatic investment appealed to Bob. Once a DRIP is set up, everything happens on its own. No need to manually reinvest dividends or time purchases. It's a streamlined process that helps you stay focused on long-term goals. Bob realized the base DRIP strategy could be supercharged by adding a set contribution every week, month, or year. He committed to investing $25 per week, that's $100 a month, or $1,200 a year. By consistently adding money, he would accelerate his share purchases. More money flowing in regularly meant he could buy additional shares more frequently, benefiting from compounding at a faster rate as each new share started generating dividends sooner. The regular additions also made dollar-cost averaging even more effective, spreading purchases across all market conditions. And because the $25 a week fit easily into his budget, the whole process felt effortless. Choosing the right stocks was essential. Bob looked for companies that met specific criteria, focusing on 4 categories: blue-chip dividend stocks, reputable companies with a long history of consistent dividend payments, think Coca-Cola, Johnson & Johnson, or Procter & Gamble. They provide a solid foundation. Dividend aristocrats, companies that have increased their dividends for at least 25 consecutive years, like AT&T, ExxonMobil, or Walmart, their long track record of navigating various market conditions adds stability. High-yield dividend stocks, stocks with above-average dividend yields, such as Realty Income, ABBVI, or Verizon. They boost immediate income, though they can carry more risk. Growth-oriented dividend stocks, companies with strong growth prospects that also pay and raise dividends, like Microsoft, Apple, or Visa. They combine capital appreciation with growing income. Bob decided that a stock should check at least 3 of those 4 boxes. Based on that filter, he selected 5 holdings to form a balanced portfolio: NextEra Energy, Starbucks, Abbott Laboratories, The Home Depot, ProShares S&P 500 Dividend Aristocrats as a diversified anchor. Individually, their metrics looked like this: NextEra Energy, dividend yield 2.76%, dividend growth rate 10.98%, annual share price appreciation 11.98%. Starbucks, yield 3.01%, dividend growth 16.69%. Abbott Laboratories, yield 2.1%, dividend growth 11.4%, price appreciation 10.31%. The Home Depot, yield 2.59%, dividend growth 17.91%, price appreciation 16%. ProShares S&P 500 Dividend Aristocrats yield 2.04%, dividend growth 20.48%, price appreciation 8.17%. If Bob built an equally weighted portfolio from these five, the combined averages would be current dividend yield 2.5%, dividend growth rate 15.49%, annual share price appreciation 10.87%. Then, Bob projected what his $25 per week habit could become, investing $25 every week, $1,200 a year, into this portfolio and reinvesting all dividends. The numbers unfolded like this. After 1 year, portfolio value approximately $2,560. After 10 years, $27,825. After 20 years, $145,500. At the 30-year mark, $823,000. At the 30-year mark. Alongside that capital appreciation, Bob's portfolio would be generating about $63,900 in annual dividends, roughly $5,280 each month. Breaking down the total gain, of the $786,500 added to his original investment, around $464,500 came from share price appreciation, and $322,000 came from reinvested dividends, illustrating just how powerful the combination of regular contributions, compounding, and dividend growth could be. Bob never needed to gamble on hot stock tips or time the market. All it took was a simple, disciplined DRIP strategy, a carefully chosen basket of dividend-growing stocks, and the patience to let time and compounding do the heavy lifting.